You get to an interesting inflection point in the stock market where you have a market that starts to downtrend, then you will have it kind of even out, and then you get a moment where everybody's like, okay, are we going to go right back down and maybe hit a new low, or are we in a situation where we're going to bounce higher and hit new all-time highs, right? And so that's, I feel like, a moment we're going through right now. And so I want to take you through my thought process and what I see going on from here in the stock market. We'll talk about that at the beginning of this video, along with some of these insane moves. I was looking at Intuit here today. I'm not sure if you guys ever track Intuit. They own QuickBooks, TurboTax, and some other products. Look at this stock. It's basically lost about half of its value from its all-time high it hit last year. Meanwhile, the S&P 500 has gone up about 9%. It just shows you the damage, the absolute brutal damage in any of these SaaS-related stocks, right? I wanted to talk about a post I did on X here today that I think is important regarding tech valuations, and if tech valuations are really so expensive or not so expensive, right? Robinhood came out with their earnings. I'll talk about that for just a moment. This kind of goes along with the market and are we in for a bigger crash from here and those sorts of things, okay? From there, I want to react to these two videos. I want to react to this one. Here's how to trade the surge in stocks. This one's from 3 hours ago. And then this one actually from last night. Dan Ives, software will be the heart and lungs of the AI revolution. I think that's important because so many software stocks are being obliterated, over the last several months. People are like, is this a generational buying opportunity in regards to these sorts of stocks, or is this a money trap essentially, right? And so we'll speak about that in today's video. One thing only I need from you guys, if you could just smash that like button, that's all I need from you. I appreciate you for joining me. I am feeling a lot better here today. I know you guys watched, I'm sure a lot of you guys watched the video on the main channel last night. I was in rough shape. I'm feeling like dramatically better today. So been drinking a lot of fluids and sleeping and all that good stuff. So appreciate y'all for joining me. And also we're V-Day sale. It's coming up here. It's in a few days from now. It is on Saturday. So if you want to be signed up for that sale, that will be the pinned comment down there. That's the only way you'll be able to receive that sale, because I will not be recording a video on Valentine's Day on a Saturday, okay? So the only way you can get that deal is you have to be signed up for that list, so then you can receive either the text or the email over to you. When we blast it out, we're going to send it at 6 a.m. Pacific time in regards to the sale, to the deal link essentially, okay, for the sale, okay? And that is going to be for the gold tier for the Patreon. That includes my #1 stock market course ever, Become a Master Stock Market, plus access to see the stocks I'm buying and selling each week, and Discord chat access to that Patreon Discord chat, okay? Alrighty, so right off the bat here, let's talk about the market. And if we have, okay, let me show you something that's a little worrying me, okay? Let me show you something. Bitcoin, it made that very sharp V-shaped recovery, but it's starting to weaken already again. And then Ethereum's weakening again already, right? Which almost makes it feel like a dead cat bounce. A dead cat bounce, that's something that's you'll hear talked about in the stock market sometimes. It's when a stock is crashing and then all of a sudden, it's gone down dramatically, and then all of a sudden it has like some little short V-shaped recovery, right? And it's like, pew, and everybody's like, woo, we're back, right? Even though you're down like 50%. And it's like, oh, it went up 10%. Now we're coming back, baby, right? All to go lower and lower and lower from there, right? And so essentially that's what we are starting to wonder is this going on with Bitcoin? Because this was like, just a very insane V here, right? But ultimately, like, it's just giving back those gains, and it looks like this just continues to be selling pressure on this asset, right? Same exact thing with Ethereum, same exact thing. It bounced hard, but now it's just flatlining and kind of trending down. And it's hard to get any real confidence around the stock market while Bitcoin and Ethereum are so weak. Obviously, those don't have any ramifications for, like, if stocks go up and down from like a perspective of, it's not like they're stocks, right? But they do from a standpoint of, are people wanting to take risk or not, right? And generally speaking, if the NASDAQ's going higher, Bitcoin's going higher, right? And if Ethereum's going higher, the NASDAQ's going dramatically higher, right? So generally speaking, that's kind of how it works. And so those were the ones just showing weakness here is definitely problematic. Now, something else I want to show you guys here that I think is very, very important. Also, it was an interesting day in the market today because I was watching a lot of stocks just lose gains, man. They just lost gains and gains and gains as the trading day went on, right? But another thing I want to talk about here in regards to this whole market drop situation is this is the latest FINRA data from margin debt outstanding is ridiculous, right? $1.2 billion hit an all-time high in December. Obviously, we're in February now, so we're waiting on the January numbers. But this is ugly, man. I mean, margin debt's out of control. It's out of control. It makes me think sometimes in the stock market, you can have a short-term drop in the market where stocks will go down, assets will go down. And it's not because, oh, the economy's crashing or like you're having a major recession or something like that, right? But it could be because of overvaluation that could happen in some assets sometimes. Sometimes it just has to do with debt, right? And people going too margined out. And it does feel like people have probably gotten a little too crazy with some of the margin-like activity. And I think you've really started to see it over the last several months hit a lot of asset classes. Like you think about the things that have a lot of leverage. That's a lot of growth stocks, and those stocks have gotten hit pretty hard the last several months. They all hit all-time highs kind of around either the third quarter or fourth quarter of last year, right? And almost every single one of them has been hit significantly since that time. Look at assets like Bitcoin, Ethereum. We know there's a lot of leverage in those sorts of markets, right? Even look at what's kind of going on in the private credit markets. It's getting a little ugly in regards to that, and also how that's affecting these SaaS-related stocks, because there's also sell-offs going on in SaaS stocks that's way beyond just like, oh, AI fears about AI might do this or AI might do that. It also, as you know, because of certain things that go on in the VC space and private credit, that's actually affecting SaaS valuations as well, where people are having to liquidate out of this to cover something else. So it feels like we got a situation here where we got to unload leverage, right? Which means what? It means assets go lower, right? The biggest question is how much do we have to unload? And that's where I feel like a lot of funds and a lot of things over the years have gotten much more secretive about leverage in the system. I think things have gotten much shadier. They've gotten more intelligent about hiding leverage in these sorts of things, right? And so it's a precarious moment for the market. It's not a precarious situation for you personally, though. You know why? Because you watching this right now, you probably don't have a bunch of leverage and a bunch of crazy crap. Now, does that mean you won't get hit? No, if leverage has to come out of the system and valuations go down, right? Well, your portfolio is going to go down short term. But the difference is you're not going to get liquidated. Now, if you're watching this right now, and I hope there's no one watching this right now that you're heavy on margin, you're screwed. You're done for, okay? I hope there's no one watching this right now. That's like that situation, because you guys know the way I've preached against margin for the last 10 years, not a good thing, right? Margin's very bad. And that's one of those things, it can have you feel on top of the world when, you know, everything's risk on, and man, you feel below the earth when, you know, it gets ugly out there, right? And so don't ever mess with leverage. You know, I look at a situation like this, and it looks to me like we've got to have a deleveraging out there in the financial markets. And that means ugly things for a lot of individuals. A lot of funds are going to go belly up. And that doesn't mean the economy is doomed. You could have a good economy while you have a deleveraging going on out there simultaneously, right? You can have those things happen at the same exact time. You could have the economy for the average person, the average American. You could have that getting better over the next 2 or 3 years. Meanwhile, you have, you know, let's call it some of these individuals have gotten way overexposed to risk and leveraging on that risk, right? Like some of these markets, we don't even know how much leverage. Like we've heard about 2-to-1 leverage, but we've also heard about 5-to-1, 10-to-1 leverage, 100-to-1 leverage. It's out of control, right? And then obviously with what goes on in the predictions market and all that, I mean, there's just messiness on top of messiness, right? And so it feels like we've got to have a deleveraging. And so now you could say, what could be the thing to get it to go crazy? That would be if some sort of black swan event happened. If some sort of black swan event came out of nowhere, that would be the match to really just, you know, have ultimately that deleveraging come. I kind of welcome it. I don't mind it. Something that makes me feel uncomfortable in the market is when I see leverage going crazy. Naturally, over time, margin debt should go up as the market gets bigger, right? But I don't like the levels we're at right now. I'll just be honest with you guys. I don't like any of that. And so my hope is it continues to happen and we get a healthier market overall, right? It makes for more attractive valuations. It just does. Like, look at SaaS. SaaS is a perfect example, right? Look at SaaS valuations for almost any SaaS-related company right now versus where it was 6 months ago or 9 months ago. It's dramatically cheaper, is it not? Dramatically cheaper. And you can look at any asset like that. Like, you could say Ethereum, right? Let's say you're a big believer in Ethereum. Would you rather buy Ethereum at 4,800 like it was a few months ago, or would you rather buy it at 2,000 like it is now? Or would you rather buy it at 1,000 like it could be going over the next 6 to 9 months if the market continues to weaken, right? Would you rather buy Bitcoin at 30,000 like it might be if the Bitcoin cycle is accurate over the next 6 to 9 months? Or would you rather buy Bitcoin at 120,000 like it was, last year? I mean, my thing is I like to buy assets for cheaper, right? And so I don't necessarily see a massive stock market crash, but could I see some more deleveraging? I think that's very, very possible. I think that's very, very possible, ladies and gentlemen. And I don't think it's a bad thing. Let me be very crystal clear about that. I don't think it's a bad thing. Now, this is something I take issue with, right? This lady on CNBC, somebody that was commenting on, they got asked her about the markets and whatnot, right? And she was talking about, like, where do you look with tech valuations being so high, right? And I'm like, lady, what are we talking about tech valuations being so high? You are so far behind the ball, right? Like, I could understand people 9 months ago making the case that valuations are so high in the market, right? They could make a case around that 9 months ago. Fair. How you make a case around that now? You just can't. I was talking about Meta's forward P's like under 20 now at this point in time. Nvidia's forward P's like 20 range. If we look at companies like anything in almost a SaaS related space, you're getting them at by far and away the cheapest price to sales ratios, PE ratios, and forward PE ratios you've ever seen at all those companies' histories, right? So I just don't think you can make a strong argument right now that tech valuations are so high. That doesn't mean they can't go a little lower in the short term. All things are possible, right? Could we see Meta go 500? Sure. Why not? Why couldn't you? Of course you could. This is possible. Could we see Amazon go under 200? Sure. Could we see SaaS valuations go down another 5, 10, 15% from here? Sure. 50%? No. 10%? Sure. So I look out there and I see tech valuations that are among the most attractive in quite some time. With that being said, as a caveat, you've got to understand there's significant risk with how much these companies are spending on CapEx, right? And these companies feel like there's a big risk to them if they don't spend enough. But you got to understand, these companies spending this much on all this CapEx is going to massively increase depreciation, which is going to hit, it looks like a lot of these companies are starting to take that line item hit in R&D area. And so their profitability over the next several years is not going to be nearly as impressive as you think it's going to be. Like, there's a potential here, ladies and gentlemen, where Meta's net income doesn't grow over the next 3 years and it goes down. You got to understand that. I don't think there's enough people have wrapped their head around that. Let me say that one more time. As a huge Meta shareholder, it's the biggest position in my public account. There's a potential that Meta's net income goes down over the next 3 years with no recession. It's very important everybody understands that. There's a potential that Amazon's net income goes down over the next 3 years with no recession. There's a potential that Google's net income goes down over the next 3 years with no recession. That's the part I think people are forgetting and not realizing in regards to this matter. And so that could mean that could also be why you're starting to see a lot of rotation. Like, if we start putting pieces of this puzzle together, that could be why you're seeing rotation into a lot of these, like, more Russell related areas or things that might actually give you earnings growth. Like, you pull up a year to date of, let's pull, a good stock to pull up is Cake here. Cake got hit pretty hard today, but still, look at the year to date for Cake. Is that what? Oh no, okay. I was like, that seems too insane. Year to date on Cake is 14%, right? Let's go ahead and compare that versus the QQQ, right, which is 100 biggest NASDAQ stocks, and then let's pull up Amazon, which is a stock of mine, huge position for me. Let's pull up a stock like I own, which is a huge position for me, Meta. Let's pull up even a Mr. Softy, a Microsoft here, right? You know what the heck? Let's pull up NVIDIA as well, okay? And let's see how Cake performs versus these stocks year to date. Look at Cake. Cake, 14, almost 15% gain for the year. Meta's up 3%. NVIDIA's down. The Qs are down. Amazon's down a lot, almost 10%. And Mr. Softy's down over 12%. That's what we're talking about, putting the pieces of the puzzle together. And so I think that's why you're starting to see some real rotation out of some of the tech-related stuff and into, companies that actually, Cake's going to grow their earnings exponentially over the next 3 years. Meta, I'm not sure about. And that's my biggest position. And I'm honestly, I got to be honest with you guys, I'm actually not sure anymore because their CapEx is so ridiculous. And they're going to have to hit that depreciation. So the way Meta and Amazon and these companies are going to start to run, even Google, right? They're going to start to remind me of Wynn Resorts. I know that's insane. That's what they're starting to remind me of. Wynn Resorts. They build these huge resorts, right? Insanely expensive, and they have huge depreciation, right? And so then if you run adjusted EBITDA and you play all these tricks and in cash flow, their earnings look much stronger than they are. But when you are playing a game of like just looking at the raw GAAP net income, Wynn Resorts is never going to super wow you because they take, every year usually they take many hundreds of millions of dollars of depreciation, right? And Wynn just calls it depreciation. These other companies basically have to throw it in some other line items. They might throw it in G&A, they might throw it in R&D. They might throw it in both those line items. But it's basically depreciation on all these chips they're buying that basically have to get depreciated substantially, right? So I don't think a lot of people understand this and maybe aren't super up to date on financial reports and how like income statements work and those sorts of things. But it's very important you get to do that ASAP, okay? Get that Become Master Stock Market course. It is the pinned comment down there. You're going to get a deal on that, okay? They'll get you up to a higher level so you kind of know exactly what I'm talking about and how all this stuff works because it's very, very important. There's a big difference between buying Meta today and buying Meta, back when I was buying Meta. Big difference, okay? Okay, next up here, Hood. So Hood came out with their earnings. I gave them a B- grade here. They had some really good things and they had some not such good things. So as far as overall revenues, up 27% for the company year over year. Now brokerage and transaction was only up 14%. Technology and development only up 12%. So anytime those line items are up less than total net revenues, that's a good news. Operations up a little bit more than revenue, so it was at 28%. Provision for credit losses took a pretty high number there, right? 89%. As far as marketing, that was up 13%. They kept that in line. G&A, general administrative, went insane. That was up 154% for the company year over year. So total operating expenses went up 38%, so that's way higher than the percentage of revenue growth there, right? Other income was up 450%, but that's a small number there. It's a very small number, right? Income before income taxes was up 18%, which is a good number, but it's not nearly as good as 27% up revenues. Ideally, you would want to see your income before income taxes up at a more substantial clip than revenue. So you'd want to see this number up 30%, 35%, 40%, something like that, not less. So, it's good they're still growing that, but it's like, not up nearly as much as it should be. Now, additionally, they had this kind of one-off here for income taxes, a $358 million hit there, so that definitely hurt them. So their net income actually went down 34% year over year, and their diluted EPS went down quite substantially as well, right, to 66 cents from $1.01. So, a little bit of a mixed bag. I think it's better than not, and that's why I gave them still a B grade, right, B-. But definitely they have some expense problems going on with the company as of right now, right? But I said that, in the stocks down after hours, I said the main fear for Robinhood, right, are really around Bitcoin and Ethereum. We know the transaction fees and what they make from that is substantial and also how that helps assets under management. if we're in a situation where the Bitcoin and Ethereum go down another 50% plus over the next 6 to 9 months, right? That's going to be tough for Robinhood to overcome that, right? But the way to really look at Robinhood, in my personal opinion, I think some people on X thought I was trying to diss on them by telling them they're a gambling company. That's the way I view them. And it doesn't mean that's a bad thing, right? Unless you view gambling as, morally wrong. But, just view them as a gambling company. That's the way I would view Robinhood. If I was thinking about investing in them, I'd basically be investing in them, kind of thinking about them as like a casino, right? You look at a lot of the activities and how they're kind of making their fees and whatnot, and you kind of do some digging on their business models, and it's like, yeah, could somebody have their 401k through Robinhood? I guess you can have your, I don't know, a 401k or your retirement funds through Robinhood. I just don't know if that's a good decision. That would be like me putting my, having my brokerage be Wynn Resorts. I mean, I just don't know if I would want that. I just don't know if that's a good idea, right? Or have Chase be also your gambling app. I don't know if that's a good thing. And so Robinhood, as they pushed into prediction markets and, harder and harder into trading and options and those sorts of things, I mean, it really feels more like a gambling platform, I would say, than anything. So, as long as you're okay with investing into a gambling company, don't feel, like it's a fair investment. Their balance sheet's great. Their income statement's very good. People love to gamble. And we're going to continue to gamble. And so I think Robinhood's one of the best plays to kind of play online gambling, right? So, but that's the way you got to look at it. If you tell yourself anything else, I think you're just kind of playing the game wrong. I think you're trying to convince yourself of things that aren't realities, when the reality is this is a gambling company. And so just look at it like that. That's the way I would look at it. And I've considered buying it, right? I'm an owner of Wynn Resorts. Wynn Resorts is a gambling company. So I don't have anything against investing in the gambling companies. Wynn Resorts, the thing I like about Wynn Resorts is they cater to the highest end, gamblers, people that, very high net worth individuals, big money, right? And so Robinhood's trying to cater to everybody. They're trying to cater to the guy who's got $500 trying to gamble and those sorts of things. So it's a little bit more of a Caesar's Palace approach, or a lower end regional casino play. But I don't know. It's good company though. There's no debating. Look at their income statements, look at their balance sheets. It's a dang impressive company, and they continue to attract people. But the stock could go much lower in the short term, so just understand that, right? Could Robinhood go under 50? Sure. Send Bitcoin down another 50% from here. Don't be surprised at all if Robinhood goes down under $50 from here, okay? But a lot of that really depends upon where Bitcoin goes from here, where Ethereum goes from here, and where the markets in general go from here.
In the East, not all that much, but we have been surging. Dow is, right? I'd said record high there. S&P's hanging in by 4. NASDAQ's given a little bit back. Retail sales were a bad miss. Capital Econ, no real positives. They describe it. But stocks continue mostly to go up because we know about this K-shaped recovery. And, as UBS says, we believe the backdrop remains favorable, driven by resilient economic growth, supportive Federal Reserve policy, and AI investment and adoption. I will say this, in terms of supportive Federal Reserve policy, Beth Hammack is the Cleveland Fed president. She's on the tape, making some comments. And she is a voter, by the way, this year. She doesn't sound so supportive of future cuts because she says she's preferring to err on the side of patience for future cuts. Quote, we could be on hold for quite some time. Monetary policy is in the vicinity of neutral. And that is the latest from Beth Hammack. So you take that all into consideration, Stephanie Link, and it takes us where?
We're going higher in the markets because the economy is doing well. We don't need the Fed. I think the Fed should cut, but we don't need the Fed because we have all of these nice...
All right, before we go further, let me just say something very important. Listen, one of the first rules you learn when you get into this game, as I learned 17 plus years ago, is the economy is not the stock market, and the stock market is not the economy. So she says, we're going higher. The economy's getting better. That doesn't mean the stock market's going higher. There can be, you can now go through time periods, months and sometimes even years, where you have an economy that's actually getting legitimately better, much better. while the stock market's going down. And I've seen it before plenty of times when the economy is not good and the stock market's going higher and people are like, what? Like, this economy's crap and the stock market's going higher? Like, what kind of foolishness is this? And I would say a lot of people even felt like that in certainly 2023. People felt like the economy was not good, and yet the stock market just kept going higher off those lows back in 22. 2009 is a great example. Market bottoms very early in 2009. I think it was around February, March. Bottoms starts skyrocketing up. People are like, look at this economy. It's trash. Like, what is the stock market doing? Like, are you crazy? 2010, people still viewed the economy as really bad. Market kept roaring higher, right? So, and even 2011, I think a lot of people still felt like the economy is bad. And they're like, look at the market just goes higher. So, just understand there can be time periods when when you look back to the tech bubble popping of that, we can call it 2000 to the market bottom, I think in 02, 03. I can't remember which year. It was either 2002 or 2003. But you look back to that time, listen, it wasn't like the economy was like, oh my gosh, the economy is so bad. The economy was fine. The economy was, for some people, really good. I remember during that particular time period, we moved out of the hood, my family, and we moved to the middle class, man. I remember it being a good time in the economy. So, I'm just saying, like, you learn that very early on in this game. So I'm kind of surprised somebody that has so much experience in the market like her comes out there and says, we're going higher, the economy's getting better. And it's like, ma'am, the economy is not the stock market, and the stock market is not the economy.
Consideration, Stephanie Link, and it takes us where?
We're going higher in the markets because the economy is doing well. We don't need the Fed. I think the Fed should cut, but we don't need the Fed because we have all of these nice tailwinds. AI, we talk about every single day, but the CapEx numbers from the Mag 7, $761 billion in total this year. That's up 75% year over year. That is a huge tailwind, but that's not the only reason
and it's so not sustainable. We got to be honest about that, though.
Economy is growing.
It's definitely a huge tailwind to the economy, but once again, is this a huge tailwind to the stock market? Man, the biggest stocks that matter the most to the market are companies like Meta, companies like Amazon, companies like Google. Like, those matter the most by far, and they're spending these fortunes of money for their net income and their earnings per share to potentially go down, right? And they can't use that on share buybacks, which would usually help their earnings per share go up substantially. And they're becoming asset heavy instead of asset light. Like, a lot of what that's saying is, like, that doesn't mean great things for the stock market, because the stock market's really made up of the very top biggest companies. Now, all that spend could mean great things for the overall economy and a ton of mid-sized businesses and small businesses. It could mean way more workers make way more money, and they can go to the Cheesecake Factory and go to North Italia and go to Flower Child. Great. But that doesn't mean Amazon earnings are going to explode higher, or Meta's, or any of these other companies that are in this kind of Mag 7-ish space.
The consumer is spending, and I care less about a December retail sales print, more about what Brian Moynihan said, the CEO of Bank of America, that January spend was up 5% year over year. So it is K-shaped. We've talked about that ad nauseum, Scott. But
that sounds like picking
positive.
And choosing data points you like
No,
versus
Wells
ones you
Fargo
don't.
said it too. Resiliency in the consumer, resiliency in corporate. So a lot of banks are saying that today, real time, and they're front center, right, of what is going on in the economy. So I care more about what the companies are saying. One big beautiful bill in deregulation has not even really hit, and that's going to be $1 trillion in stimulus. Inflation is coming down. I thought the ECI today was pretty good. And then finally, productivity. And that is the real story of this economy, and that's driven by AI and all the technology. Add it all up, double-digit earnings. Earnings are getting revised higher. That's why the market is going higher.
Okay. I mean, UBS, Steph, been saying the same thing. It's hard to argue against it. I mean, some of the consumer stuff's squirrely. It doesn't look great, but then there's other offsets to the retail sales report.
There are, and I think we should be a little bit more excited coming into the show today. It seems like a quiet market day, but it's really not. And it's not because you're maintaining the gains of the last several days. And you have a variety of different stocks that are reacting to what is a really strong earnings season. And we've had elevated volatility, and I keep talking about that.
Are you suggesting that Steph wasn't excited enough in her first answer? It sounded pretty passionate to me.
Pretty excited.
It sounded pretty passionate.
No, just coming into the building today, talking to a lot of the different traders on the floor. What's going on? Oh, it's kind of a quiet day. We're moving somewhat sideways. I like the fact that it's quiet. I like the fact that you are stabilizing at a high level.
Okay.
That is productive. And one last point on the volatility. I keep talking about elevated volatility. The one market you don't have the elevated volatility is arguably the most important, and that's the bond market. The bond market remains remarkably calm, and that is good for credit availability and the cost of capital not being a moving target.
Josh, if you're...
So this is really fascinating. Check this out. This is around Thanksgiving, which is roughly around the time market bottomed, right? And we got the government to open back up, or, roughly around that time, and all those sorts of things, right? And look at how much these stocks have diverged since then. You look at a stock like Cake up 40% since then. Meta's up 13%. Q's up 4%. Nvidia up 4%. Amazon down 4%. And Mr. Softy, Microsoft, down 13%. If we pull up a 3-month on these babies, so this backs it up to, we can call it November-ish, right? Cake up 30%, Meta up 5%, Q's down 1.6%, Nvidia down 4%, Amazon down 16%, and Mr. Softy down 18%.
You probably hang on is consumer strength starting to falter? That's what Capital Econ says today as they look at the retail report. If you're bullish, you are like Steph and UBS, which suggests the backdrop's still really good. Resilient economic growth, the Fed's still supportive, don't hang on what the Cleveland Fed president is saying. It's just one person and one vote. And AI adoption is yet another reason to be bullish. So what do you make of all that?
Well, Steph is right, and Steph has been right. And, there's a whole cottage industry of people who want to nail the turn exactly as it happens. So they see a negative data point on the consumer, and they spin it up and extrapolate it into this whole thing that's just not based in reality. I know we're going to talk about the travel stocks later, but I'm sorry, Hilton and Marriott is not like me pointing at to the Four Seasons Hotel. So yeah, it's K-shaped, but honestly, people are not voluntarily crisscrossing the country on vacations if the consumer is cracking. It's just not the way reality works. So I know how badly people want that turn, and they want to be see. I told you. But the thing is, you listen to the JP Morgan conference call. They issue everybody's credit cards. They see all the debit card spending, et cetera, et cetera. And they almost have to apologize. Jeremy Barnum has to come on the call and say, guys, I know what you're all looking for. And once again, 12 straight quarters, it's not here. There is no sign of exploding credit card liabilities and past due this and auto loans being payments being missed. We don't have it. I'm sorry. So until we do, how about we focus on exactly what Joe and Stephanie are talking about, the absurdly strong earnings picture. If you think about it, analysts are now expecting profits to grow 12.3% year over year. That is 386 basis points ahead of what the estimates were right before we got the first reports of the season. So 8.5% was the expectation, and we're doing 12 and change. This is quarter after quarter after quarter. So I'm not saying every consumer is okay. I'm pointing out, for the most part, that is not the story. It's not.
Yeah, the main issue for the market coming into this year, one of my main concerns was everybody's already bullish, right? And that makes actually a very tough backdrop. When everybody and their grandma's bullish on the market, it's like, do we have any more bulls to pull over to the side now at this point in time, right? And so even though, numbers are great, it's harder to get people super enthusiastic because everybody's like, we expect it to be great, right? Oh, it's a little better than we expected. Okay, cool. It's like, it's a big surprise when people are expecting meh, and you come in with good or great. Or they're expecting bad and you come in with good or great. That's when you're like, okay, now we're talking. But when everybody's already like got these sky high expectations and you come in a little better, it's like, okay, if you expect your kid to get straight A's all the time and he comes in with an A+, it's like, okay, cool. It's not like when your C student comes in with a grade A, you're like, oh my gosh, what happened? You're a genius.
I mentioned at the top of the program that you moved a couple of really beaten down names into your AI 20, that being Salesforce and ServiceNow. What do you make of what Jensen said amidst all of this skepticism about that space?
I think the hearts and lungs of the AI revolution will be in software. Now, look, right now it's data center build out, GPUs. I mean, you're still in the early days of this, it's going to be a 10-year build out. But software is going to be key to the use cases. I mean, it goes to our point. If you look at Palantir, and ultimately followed by Snowflake and Mongo, in my opinion, to say Salesforce and ServiceNow are structurally broken companies, to me, look, in my career, I think it's the most disconnected call that I've ever seen. Investors thinking that software is not going to play a huge part of the AI revolution.
It will. That's not to say that certain ones aren't being disintermediated in a extraordinarily large way, or there's a belief, if they're not today, that they will be tomorrow, right? As Brad Gerstner was telling me, you're not selling these stocks because you are so upset with what's happening today, but you now more than ever need to see some justification for the multiples that these stocks have commanded. Let's take that. What's the PE of Salesforce and ServiceNow? Can we show that? There it is. So, okay, Salesforce is down to 15. The forward on service is almost 25. Is that justified?
Well, it's my view that like the monetization, because like when I look at the revenue for a ServiceNow or Salesforce, I could argue there's 20-30% incremental revenue from where they are today. We're talking, ultimately tens of billions of dollars when it comes to Salesforce that are not factored in to the valuation, because I get in the near term it's a headwind. Benioff, I think, would be the first one to admit it. But to say that Salesforce and ServiceNow, given how integrated they are in enterprises, in the stack, you look at the hundreds of thousands of customers, as these use cases play, you haven't seen it today, but in the next 6, 9, 12, 18 months, I think what Jensen talked about is exactly right. You cannot paint all of them with the same brush. You can't just say an SMB pure play they're going to be impacted as much as a Salesforce, an Adobe, a Workday.
I mean, not everything has traded miserably, but obviously so many have. I mean, when you look at all these companies, how do you know what justifies a higher multiple versus ones that don't? We showed a pretty...
Yeah, so I don't want to speak to every single SaaS-ish related company, right? I don't track them all. But what I can tell you, and I don't even think this is an opinion. I think this is just facts. Intuit, Adobe, ServiceNow, Salesforce, they're some of the best business models in the world, right? In the world. What makes them some of the best business models in the world? Well, they have customer bases that have incredible resources, right? We're talking about companies, right? Big businesses. They're all very intertwined with big businesses. I mean, Intuit's a little bigger when it comes to small businesses, but these are products and services that are so intertwined with a business's operations, it's nearly impossible to get rid of them. You could, right? But it's like, why would I want to? Like, if we had to switch from QuickBooks to using something else for my small businesses, like we could. Would we want to? No. Like it sounds like a nightmare. Like we just no. Like we're fine paying our money we pay to QuickBooks and Intuit, and that's fine, right? If you have CRM, different product suite in a large enterprise, like especially on the sales and marketing side, like that's tough to get rid of, right? Adobe's so intertwined with big businesses, like to switch out of all Adobe's product suite. You could do it, but it's crazy. And the fact that, people don't understand, like when it comes to these big companies, the cost of running something like Adobe is a fraction of your overall marketing budget. Like you've got to use their products, so their products are the best of the best. People think, these big companies, they'll just create some AI generated image, and that's what they're going to use for their marketing banners and for their TV commercials for the Super Bowl and all this stuff. And it's like, dude, what are you talking about? Like, you're crazy. Like, it's just not reality that happens, right? And if you've played around with these image generating things, you realize, man, I could just do this so much better myself. It's not doing this right. This color's off. This isn't right. This isn't right, right? And obviously Adobe's product suite is much more vast than the example I'm giving here. That's just like one example, right? And the ServiceNow, oh my gosh, like you're talking about, what really connects a large corporations, like different departments together. Like, when you just run through it, it's like, I mean, these are the best businesses in the world. And also what makes them so incredible is also they have revenue growth. We talked about how sticky these business models are and how tough they are to get out of them. Like you can get out of any product if you want, but it's just like, why would you want to, right? They come out with new products and features all the time. All these companies have research and development teams. Their revenues don't just keep going up magically because they charge more for the same product. That's not how it works. Sometimes they'll do that. Sometimes they'll increase price, but that's not actually how to do it. They usually do it because they're attracting way more customers and they're selling more and more new products and features to their existing customer base. Then they go buy other companies and they sell those products to their customer base. That's how CRM became a giant in the space over time, right? And will become a much bigger company. So, and their workforces are incredible. And did I mention they're asset light, right? And incredible margins. Like these are some of the best business models in the world. And they're just all being thrown out right now. I'm sure there's going to be some that are going to be disrupted by AI, right? That, but those are going to be the companies more so that are not super intertwined with large companies and mid-sized companies and small businesses. The ones that are just easy to just kind of like replicate and get out. But I can tell you, these sorts of companies are not those. They are not those. And they have incredible, it's also fascinating for, the stock market to have this disillusion of like all these big companies we just spoke about, ServiceNow, CRM, Intuit, Adobe. You do realize these companies have great management teams, as in proven management teams. Not, these companies that people think are going to disrupt them, those aren't even proven management teams of those companies. Did you ever consider that, right? They haven't even proven like business models yet. So it's like, maybe they're going to be amazing. Maybe they're the next Zuckerberg or the next Bezos, or maybe they're not. We'll see, right? We'll see. But the other thing is people assume like the employees of these companies are not talented. And it's like, dude, you got some amazing engineers at all those different companies. So, but the market just runs with whatever narrative it wants to run to in the short term. And a lot of that comes back to, I think, leverage in the market and some of those other things we spoke about earlier.
Discrepancy in the forward PEs of both of these names, which have equally gotten hammered. Can you look at a Salesforce and say, okay, at 15 times earnings, that stock has corrected enough that it looks attractive. But just because you can make that case for one doesn't necessarily mean you can make it for the other, but you are.
Because I view it as, Salesforce is the one. If there's one name that's been so dislocated relative to what I believe what the opportunity would be, it's Salesforce. And I can also argue some of the cybersecurity names like Palo Alto and CrowdStrike. When I look at ServiceNow, betting against McDermott has been the wrong move. If you look at that install base, now I could say they were early on in terms of AI, and now they're really sort of being viewed as they're going to be disintermediated. But Scott, like I've talked to 40, 50 CTOs, CSOs, IT managers over the last week to make sure, the stress has to make sure that I'm not looking at it wrong, and I feel further conviction in this
but can you just those that's like asking people on the football team, hey, how's the team? Everybody's like, hey, we're great. Everything's great. Can you trust that you're getting the best opinions on what's really happening by asking the people who are at the companies where their stocks are declining? Aren't they all trying to...
I'm talking about the buyers. I mean, the buyers of Salesforce, the buyers of ServiceNow, the buyers of cybersecurity. And I feel I come away viewing this as, I'd say it's a generational type of opportunity in terms of what's happening in software.
Okay. Let me ask you this. Microsoft got downgraded today by Melius, which says, quote, Satya lost the AI narrative. I know you're going to counter that, but doesn't the stock kind of worry that Melius is right?
Yeah, and Ben, an analyst, who I have huge respect for. I think,
is there a but?
But the AI revolution is not going to be successful unless Microsoft's successful because of how integrated they are in enterprises, in Azure, in the backyard of, ultimately really the core enterprises movement to AI. Have they hit some sort of perception soft spot here relative to Azure, relative to CapEx in terms of that not all being allocated to Azure? Yeah. But I think this is one where, when I look at Microsoft, I think it's stock that has a 5 in front of it and a 6 in front of it over the next 12, 18, 24 months. I just think near term, right now, it's a guilty till proven innocent.
Well, I mean, how do they prove themselves to be innocent? Melius suggests today that they need to increase their CapEx markedly. That's the word that they use, not me, to keep pace with what Google and Amazon are doing. So their free cash flow, at least in the near term, is going to take a big hit. Isn't the market, aren't investors going to have a problem with that?
I think investors clearly, you've seen that since the quarter, right, in terms of the sell-off. My view is that when it comes to Microsoft, they're not going to have to increase CapEx maybe to the level that they're talking about, as well as also when it comes to the enterprise, the monetization, they've only monetized 5% of their enterprise customers. That's why I'll bet on Nadella and Redmond to navigate this. Look, right now, it's, there's obviously very negative sentiment, and I get the call.
So one of the most genius, I feel like, bets an individual can make in the market right now, in terms of, if we just think about 2026 buying stocks, like what is one of the most genius ways to play things? This is my opinion, okay? Buying Nvidia and AMD, simultaneously buying SaaS stocks, I think is the most genius thing in the world. Why? All these companies spending all these ridiculous sums of money for years and years to go in the future on Nvidia chips, obviously AMD chips, right? Okay, boom, you got that. SaaS, all these companies have been killed, right? Let's say AI is everything it's cracked up to be and then some, right? Well, you think these companies are going to stop buying NVIDIA chips and AMD chips? No, they're going to keep going, right? Which means NVIDIA's valuation has a long way to run, and then AMD's got an insane amount to run from here, right? Let's say, maybe AI is not cracked up as much as we thought it was going to be. Then SaaS is going to be just fine, and those stocks will bounce hard over the next several years, right? You say maybe that'll lead to some weakness in NVIDIA and AMD over the next few years, right? But these companies kind of still have to spend just to save face, almost, in regards to that situation, right? So I honestly think that's the best way to play it, because it's either AI is this game-changing, oh my gosh, amazing thing, and so you got to spend every dollar you possibly can on it, or it's not kind of what we thought, and then SaaS explodes higher, or maybe it's the best of both, right? Where it's like AI does some things amazing, and yeah, it messes up some companies' business models, but companies like CRM, companies like Now, companies like Adobe, companies like Intuit, they make it through just fine, out to the other side, and guess what? Brighter days ahead, right? Meanwhile, AI does some things really good, and so people continue to spend for the next several years on NVIDIA chips and AMD chips, right? I think that's actually a good way to play tech, right? So, and I mean, obviously you always got the big dogs, right? You got the Metas and the Amazons and the Googles, which those companies could always, in a snap of a finger, say, well, you know what, we're not going to spend as much. That would obviously be very negative for stocks like NVIDIA, stocks like AMD, but that would be actually probably good for those stock prices, because that would, take this huge risk of profitability going down over the next several years, or flatlining, that would take it out, right? I appreciate y'all for joining me. As always, thank you so much for being here. Thank you for being subscribed. Happy to be feeling a lot better. Our massive one-day Valentine's Day sales coming up here in a few days. Pinned comment down there. Click on that. Put in your info, and we'll send you over that deal when it drops. That tier is usually $145. It'll be $49 a month for that particular day. And that's access to my #1 course ever. That's access to the stocks I'm buying and selling in my Patreon portfolio each week. Access to the Patreon Discord chat. All that good stuff. It is gold tier. Much love and have a great day.